All right, the HUD-1 is another document that is required, but usually at the closing or right before the closing. This is completed typically by a closing agent. This itemizes all the fees. It's put together again by a closing or a escrow agent, and they're going to show you overall itemized, listed out, what fees are paid to whom and who pays them. The good faith estimate is a lumped together document. The HUD-1 is a itemized document. You do need to remember that. Now, HUD-1A is something that will be used in the event there is no seller. You will see here in a moment that the HUD-1 settlement statement has one side for the borrower and one side for the seller. But if you have no seller, because it's a refinance, you may end up just using the HUD-1A. Same thing, just without a seller. Now, under RESPA, we talked earlier about the I always have trouble with that word, affiliated business arrangement. This means if you own 1% of another business, you have to disclose that relationship to the borrower. All right? And this can be pretty much anything. It's 1%. But also, it matters if you have a personal relationship with that other business as well. Example. Let's say my name is Charmin Lane, but that's my maiden name. And my husband is a real estate agent and he has a different last name. Would the customer know that he and I are married unless they saw a wedding picture somewhere? Probably not. So our household income is going to gain significantly by me doing the loan and him doing the real estate. Well, that personal relationship has to be disclosed to the customer. That counts and is just as important as if you had a 1% ownership interest in the business. So personal or business relationship, but what is considered personal relationship? Parent, child, or spouse. So if my husband's the real estate agent on the same transaction, we have to disclose it. If my mom is a real estate agent on the same transaction, I have to disclose it. If my kid is the real estate agent on the same transaction, I have to disclose it. All right? Now, under affiliated business arrangements, there is acceptable compensation, which basically means my mom or my husband or my kid can make reasonable compensation that they would have made anyway on that transaction. We're not eliminating how much people can make. We're just saying you have to disclose the personal relationship. There is a bona fide compensation from an ownership interest. So again, if I own the escrow company and the mortgage company, I'm allowed to make my legitimate fees on the loan, and I'm allowed to make my legitimate fees on the escrow. Now, in the example that it was my mom that works for title company, escrow company, real estate, whatever, if she wants to pay me a referral fee for sending somebody or referring someone to her, no. That's a violation of Section 8 of RESPA, which is the one that prohibits kickbacks. She can make her fees, I can make my fees, we just can't pay each other anything, okay? Because that's paying a referral fee. All right, when it comes to TRID, again, it sounds like you need to be hospitalized for this, disease or disorder or something. TRID, I got TRID. I don't know what that means, it just sounds scary. So TRID means TILA, RESPA, Integrated Disclosures. This is the combined form. It's a law that went into effect in 2015 saying, okay, back in the day, we used to use good faith estimates and HUD-1s, TILA disclosures. We're trying to simplify things because come 2008, we've got this massive mortgage crisis. So the documents and the disclosures were all revised in 2010, and new documents were needed to be used, which is the ones you just saw, the TILA disclosure, the settlement cost booklet, the HUD-1, the good faith estimate, and all that good stuff. Well, they were revised again in 2015 because we just weren't doing a good enough job of making sure that this was broken down in layman's terms for the average consumer to understand. So that's when TRID went into effect in 2015. First off, the good faith estimate and the truth in lending disclosure have been combined into this new form. It's called the loan estimate. So remember before I said some cases you'll use the good faith And some cases you'll use the truth in lending. In some cases you will use the combined form, okay? That's what I'm talking about here. This loan estimate is a combination form that includes good faith information and truth in lending information into one easy to read document. Okay, the new loan estimate was designed hopefully to help consumers understand what their loan entails, the details, the fees, the costs, the rates, things of that nature. So it's really made to help consumers understand what they're getting themselves into. Again, the time frame stayed the same. It still has to be given within 3 business days of receiving pencil. The other combined form is from HUD-1 of RESPA and the Truth in Lending Disclosure have now been put together, combined to be called the Closing Disclosure. All right, this is designed to help provide the disclosures to help consumers understand the costs of the transaction. So again, one's given at initially within 3 days of taking pencil or the loan application, and the other is given at closing. So one's the loan estimate, the other is the closing statement, all right? Or the loan closing estimate, the closing disclosure. The closing disclosure form must be provided to consumers at least 3 business days before consummation of the loan or the closing of the loan. So again, your time frames pretty much stayed the same. It's just which disclosure you're giving that has changed. New disclosures, TRID, does not apply to equity lines, reverse mortgages, dwellings that are not attached to the real property, the land basically, and loans that are made to people or by people who do less than 5 loans a year and they're not considered a creditor. Now, this is your new loan estimate form. Supposed to be simplified and really put down into just common terms that most everyone understand. Loan amount, here it is. Can this increase after closing? No. Pretty clear, right? Interest rate, not your APR because you don't really care. Well, you care about the APR because it's a combination of the rate plus all of the costs, but it's a very confusing number. This is your rate. Can it change? No. Principal and interest payment, this is what your monthly payment is. Does it have a prepayment penalty? Yes, in this example. Is there a balloon payment? No, in this example. Payment calculation, in the first 7 years, how much will my payments be? Here's your principal and interest, mortgage insurance, escrow, total, right? Now remember, anytime you buy a house, government wants their share, taxes. But you also want to make sure that you have an insurable asset. If that house burns down, I don't think you're going to want to be homeless. Insurance is also an important item to have when you have a home, and if there's a loan on it, the lender requires it. So estimated taxes and assessments, here's your estimated taxes. Are they included in escrow? Property taxes, homeowners insurance, yes or no? All right, years 8 through 30. The reason there's a difference between years 1 through 7 and 8 through 30 is there are certain laws that we'll talk about a little bit later on that say you have to qualify the borrower on the highest payment that they will have within the first 7 years. If you've got a 7-year ARM, then you just go off of whatever the first 7 years are. You don't have to requalify it after the 8th. Some of those, depending on the category you fit into, you do have to disclose whether or not you do have to qualify on whether or not the rate's going to change or the payment's going to change after the 7th year. So again, years 8 through 30, payment, mortgage insurance, estimated escrow, total payment, and this would stay the same because it's based on the property value. All right, estimated costs at closing. This is important to customers. We want to know what's it going to cost me to get this loan and how much do I have to come in to closing with, or how much cash do I have to bring to the table? What's the difference between these two numbers? Well, if I'm putting 20% down payment on the loan, house is worth $100,000, 20% is $20,000 plus all my closing costs. That's that number, the estimated cash to close, okay? But the actual closing costs are costs that are charged by other vendors per se to do this service for you. So that's going to be title, escrow, appraisal, lender fees, credit fees, things of that nature. So these are the costs to close the loan. This is the estimated cash to close, which is your down payment plus all those other fees. Important things to know. Now, I won't call it problem, but the loan estimate form is longer than the old good faith estimate. The old good faith estimate was 3 pages, and back in the day it was 1 page. So the big question is, have we made things easier or harder? Well, the language is easier here, but it's a little bit longer. I think it's 5 pages. So big question is somebody going to follow along with the information if it's back on page 5? Or would they have read it all if it was all just on 1 page? So we've made the language more simple, but in order to do that, the documents had to be a little bit longer. So here again, closing cost details. This is an example on a purchase transaction. Loan costs, origination fee, application fee, underwriting fee. Okay, section B, services you cannot shop for, but there's still fees to do the loan. Appraisal fee, credit report fee, flood determination fee. These are all services that are kind of like pass-throughs. The lender collects for the appraisal, but they don't keep the money for the appraisal. They pass that on to the service provider that did that. So these are fees required to get the loan, but they're not kept by the lender. That's up here. These are other services you cannot shop for. These are services you can shop for, like insurance, lender's title, title insurance, owner's title insurance, settlement agent fee, and title search. These are things you can shop for. Other costs like taxes and recording fees. Section F is prepaids. 6 months insurance premium, mortgage insurance, prepaid interest, property taxes. G, item G, initial closing or initial escrow payment at closing. These are the items that collect for taxes and insurance. At closing, we need X dollars. Other, title, which is the owner's title insurance. That's what's going to go here, and again, it's something that you can shop for. Total other costs is the dollar amount there, and the total cost, which is D&I, which is the total loan cost plus the total other costs, equal the total costs. So again, there's no mortgage language thrown in here. It's all pretty simple terms that most anybody who's buying a house will have heard. And then calculating the cash to close. This is just basically where we came up with the number that you have to close with. So it's your closing costs, any closing costs that were financed, so you included that in the loan amount. In this example, it's 0. Down payment funds from the borrower. If you've already put a down payment in and you've given that money to the escrow company or to whoever is holding it in trust, that amount would be here. Deposit, how much did you put down? That's here. Funds for borrower, if money's going back to the borrower, that amount would be there. Seller credits, if the seller is going to pay for any of your closing costs, that goes there. And any adjustments and other credits to equal the total that you need to bring to closing. All right, so again, down payment funds from the borrower. This is, again, if you're putting 20% down on a $100,000 house, that number would be $20,000. That's how much money you have to give to the escrow company to cover your down payment, and then everything else is cost-based. All right, now on a refinance transaction, again, estimated cash to close. For the amount estimated cash to close, the sum is the total of the loan amount, the closing costs, and the payoffs and payments. So total other costs, about $2,000, a little bit more than that. Total closing costs, $5,099, but there is a little bit of a lender credit, probably because you chose a rate that gave you a little bit of a credit. Loan amounts, $150. Closing costs, $5,099. Estimated total payoffs and payments, $120. Remember, this is a refinance. So I'm getting a $150,000 loan to pay off my $120,000 loan. I'm probably going to take home a little bit of cash. Okay, in this example, estimated cash to close to the borrower, which means you're not coming in with money, you're taking money away from the transaction. And estimated closing costs that are financed was the $5,099. Again, fairly simple concepts in a clean, easy to read form. All right, so the next piece of the TRID disclosure is still on page 3 under the loan estimate, but now we have a term you may not have ever heard of before, and it's called TIP. That is the total interest percentage. And this is the total loan interest that basically is what the borrower is going to pay over the entire course of the loan. So that's something we've never had on any historical disclosure before, but I think it is pretty much a valuable item to have. Now, in 5 years, total you will have paid in principal, interest, mortgage insurance, and loan costs, and the total principal you will have paid off. So that's kind of an important number. That's in 5 years, as the example reads. The annual percentage rate, this is the only time that you see the APR, which is really interesting because on all the other disclosures, all throughout the beginning of time since we've ever had these laws and these disclosures in effect, APR was the only thing that was given very big, very bold, very prominently on the very first page of your disclosures. And now it's less of an important item as long as people know what their interest is, what their actual note rate is, and what their fees are. Right? And then the total interest percentage in this example is 69.45. It is the total amount of interest that you will pay over the loan term as a percentage of your loan payment or your loan amount. Pretty big number, right? But again, if we didn't have loans, how many people would actually end up buying a house? You'd have to have full cash, which is what they did again before Fannie Mae and Freddie Mac, because you had to have big down payments, short period of loans, and very high interest rates. The invention of Fannie Mae and Freddie Mac did allow us to buy loans and pay them back over a much longer period of time. Now, still going on page 3, other considerations. Statement about the appraisal and how it has to be provided in order to get a loan. Higher priced mortgage loans, we'll talk about those earlier. This is what we mentioned before, which was 1.5% over the average prime offer rate, 2.5% over the average prime offer rate, or 3.5% over the average prime offer rate when you are doing a loan based on either a first mortgage, a second mortgage, or a jumbo. All right, so again, and this also says that loans are covered by the Equal Credit Opportunity Act, which is all about discriminatory events based on special protected classes who are trying to get mortgage loans. We'll talk a little bit about ECO a little later on. All right, confirm receipt. Please note, the consumer is not required to sign the loan estimate form. All our job is in the mortgage industry as loan officers is to make sure our consumer or our borrower gets the disclosures. They don't have to sign them, at least not at this point. It's just that we have to prove that we got them the disclosures. So then we've done our part, which is we gave it to them. It's up to them if they want to read and sign it. All right, closing disclosure, page 1, the closing information, all your basic stuff, date issued, closing date, disbursement date, all this information is going to be on the closing disclosure. Now remember, there are 2 disclosures now, the loan estimate and the closing disclosure. These are your combined TRID disclosures. And I just realized as I said TRID disclosures, that's actually redundant because it's the Truth in Lending RESPA integrated disclosure. So now I'm saying disclosure. So welcome to my world of craziness. All right, closing disclosure. Some of it is still similar information that you saw on the estimate to kind of keep things consistent. Loan amount, interest rate, payments and interest, prepayment penalty, balloon payment. Projected information, years 1 through 7, 8 through 30, costs of closing. It's all looking very familiar, right? This is where we mix it up a little bit. Borrower paid, seller paid, very similar to the old HUD 1. Loan costs, settlement services, services paid that the borrower did shop for, that they did not shop for, closing costs. Is it paid by someone else, like the lender in the event that you do a credit? This could be if there was some error made and someone else paid for it. Okay? Other costs, again, the breakdown of that, we went through all of this earlier, escrow stuff, the other stuff, homeowners associations, warranty fees, real estate commission, everything here fits into your pretty much your other category. It's not lender fees and it's not broker fees. All right, calculating cash to close. On the estimate, this is what we said you were going to be charged. On the final, this is what, or on the closing disclosure, this is what your actual numbers were. All right, well, this one here is a little bit higher. This one here is a little bit lower. This one here was the same, little bit higher. So your actual cost is less. I'm sorry, we thought it was going to be 0 and you ended up getting a credit. All right, did this change? You don't have to do the math. You don't need to know what these negatives and positives mean. Yes, it changed. See the total loan cost and other costs credit. It shows you what items changed. All right, yes, no, yes, see the seller credit section. Broken down in a really simple, easy to understand way. All right, this is the summary of the transaction on page 3 of the trade closing disclosure. Summary, due from borrower, due from seller. Now, if it's agreed to that the buyer and the seller are going to get a combined form that has both buyer and seller information on it, that's fine. You can opt to only have your information on your disclosure. I would not want, as the seller, the borrower has no business needing to know how much I took home, what my loan payoff was. That's none of their concern. So if it were me, I'd say, nope, I want a single disclosure with just my information. Do not want the buyer or seller to see what my details were. It's none of their concern. Okay? But again, pretty simple, basic stuff. Paid already, due from seller, due from buyer, unpaid by seller. Everything here is just a breakdown. City, town, expenses, HOA dues, excess deposit, how much did I put in? Was there any? All really clean and clear stuff. Most of these definitions or most of these items, people know what they mean. They're done in layman or common terms nowadays. All right, on page 4 of the loan disclosure, just kind of a little bit about explaining what it is that you just read. Is this loan assumable? And it explains what assumable actually means. Demand feature does not have one, or it does. Late payments, it explains what happens in the event your payment is made, 15 days late or whatever the lender's chosen. Negative amortization. You don't really see loans with negative amortization anymore. You need to understand the concept, which is, I'll show it to you a little bit later when we get to mortgage loan originator activities. All right, does it have an escrow account? Escrow account is, again, are you paying taxes and insurance through the mortgage payment? If so, it's going to be detailed there, and all of the different items. So the total cost to be escrowed, non-escrowed property costs, initial escrow payment, and the monthly escrow payment. So again, all broken down into simple, easy to understand terminology. Loan calculations, if you're wondering how your TIP was calculated, how your APR was calculated, all explained for you right here. Other disclosures, this is what an appraisal is, this is why you need it. Contract details, this is what it is and this is what you need to pay attention to. This is what it does for you. What's your liability after foreclosure? What's a refinance due? What's the value of it? Tax deductions, how this loan can give you a tax deduction. So really breaking down all the odds and ends that make up a mortgage loan and explaining them again for the umpteenth time, making it in common terms so that anybody can understand it. All right, contact information. Yay, we get to know who our lender is, our broker for real estate, our settlement agent, loan broker if there was one, or mortgage broker. So again, you get all the contact information. So if you just saved this form, you had questions on your loan or how it closed or what happened, yeah, you're gonna have easy contacts for all of it. Now, this here is something I'm really excited about, but I think things like workbook activities are kind of fun because I'm a nut that way. This is what we call your home loan toolkit. This again it falls under TRID, where this actually replaced the settlement cost booklet. Now remember, the home loan toolkit will only be given on those transactions that fall under TRID. If you fell under the Truth in Lending RESPA rules or the RESPA disclosures, you would be getting instead the HUD settlement cost booklet. All right, so this basically replaced the settlement cost booklet, but only on certain transactions. I really like this toolkit. It's kind of fun. I think the word toolkit on a loan is a little bit weird. I think it should have been like workbook or something, but be that as it may. How can this toolkit help you? After you finish this toolkit, you'll know the most important steps you need to take and get the best mortgage. You'll better understand your closing costs. You'll see a few ways to be a successful homeowner. So we're going to go through this cool toolkit just so that you can see what it is. The bad news is it's 25 pages. So is a consumer really going to sit down and read this when they are getting a loan? Disclosures are one thing that are mandatory. It's smart to read them, but is somebody going to go the extra mile and do this little workbook on their own? I don't know. I'm hoping they will because it has some really fun and valuable information in it. So define what affordable means to you. Part of the crisis in 2008 was because people got themselves into homes they couldn't afford, mainly because they didn't understand how their loan worked. Well, this is going to kind of put the onus back on the consumer. You've got the information, use this toolkit, and you'll know whether or not this is a property you can actually afford and if the loan is the right one for you. All right, so choosing the best one. And the talk, this is actually something that's kind of cute. Ask your spouse, a loved one, or friend about what affordable means to them. What's more important, a bigger home with a larger mortgage or more financial flexibility? How much do we want to budget for all the monthly housing costs, including repairs, furniture, and new appliances? What will a mortgage payment mean for all of our other financial goals? Those are actually pretty good questions to ask. Sometimes people just get blinded by, I want to own a home, I want to own a home, and they don't think about these other important items. So this is, again, a toolkit allowing them to do that. All right, so here's some of the details over here about just HUD and how all this came about. But this is know your numbers. So here it is telling you your total monthly home payment is more than just your mortgage. There are more expenses that go along with owning your home. Okay, most people know that, but they don't break it down into the finite details of how much they bring in and how much is going to go out. So here, principal and interest, they tell you to calculate that payment or come up with the payment from your disclosures and write it in here. How much you're going to pay in mortgage insurance, put that there. Property insurance, homeowners association dues if they apply, and what's your total outgoing payment. You've seen all this on your good faith estimate or your loan estimate. Why are we doing this again? Well, it gets a little interesting. Something that's kind of fun, they actually show you monthly estimated home payment divided by my monthly income before taxes and multiply that by 100, and we're going to get our debt ratio, okay? If you make $10,000 a month and you have $5,000 a month in monthly expenses, you have a 50% debt to income ratio. That means 50% of your income is going out towards monthly payments. But it doesn't consider things like utilities, like television, like food or gas or anything other than what shows up on a credit report, essentially. So having said that, this is my favorite part of the home loan toolkit. Estimate what is left after subtracting your monthly debt or your monthly payments. Total monthly income after taxes. Many people don't realize your mortgage payment or your mortgage qualifying is based on gross income. Who takes home gross? Nobody, right? So you want to make sure that you're calculating real life numbers. This qualifying is based off of gross, but real life is based on net. So total monthly income after taxes. My estimated total monthly house payment. That's from that principal and interest above. Monthly car payment, student loan payments, credit card payments, other payments like child support or alimony, all right? And the total monthly income minus all debts. What's left over is left here, okay? Am I comfortable with a total monthly payment of X? Now, mind you, total monthly income minus all debts. Read the fine print with me. This money must cover your utilities, groceries, childcare, health insurance, repairs, and everything else. If this isn't enough, consider buying a less expensive house or looking at putting in more down payments so your loan is more, or again, maybe now is not the right time for you. But I think that's really valuable because so often people do not realize there's more to owning a home than just that monthly house payment. This gives you a real clear picture of what your finances look like after you've purchased that home. All right. Again, understanding your credit, I think this is another fantastic tool. Everybody and anybody can go on to annualcreditreport.com and get a free copy of their credit report, one from each bureau once a year. So you could schedule it out so that once every 4 months, you're going to pull your credit report from a different agency like Experian, TransUnion, or Equifax, and take a look at what your credit looks like. This is really valuable for, number one, is there any fraud? Have you had identity theft? Really important to be aware of that today. So many places you've seen have been hacked. So it's really good to know, what does your credit look like? Have you been compromised in any way? All right, again, this is some just resources on how to know what your credit looks like. Now, if your credit score is 700, if your credit score is below 700, you will likely pay more for a mortgage. All right, so it gives you some ideas on how you can actually fix your credit, lower your debts, increase your buying ability. All right, pick the mortgage type, fixed or adjustable, that works for you. Again, a really valuable tool. It explains the difference of the fixed rate versus that of the ARM and gives you things to actually think about, like balloon payments. Does it have any risky features? You could say all day long to a consumer years ago, hey, Mr. Borrower, make sure you're looking out for those, aggressive or risky loan features. Okay, what if I don't know what those features look like? Well, then it's going to be pretty hard to identify, right? Well, it explains what some of those loan features are and how to kind of be wary of them, right? Down payment. Should I put down 20% or more? Should I put down between 5 and 19%? Should I put down less than 5%? Or no down payment at all. Again, it kind of works like, should I have this rate with these fees, or this rate with these fees, or this rate with these fees? It's up to you. It's just a matter of considering all of your options and making the best choice. Because mortgage loans, they're not cookie cutter. It is not one size fits all. So what you want to do is make sure that you are looking at all of the information and looking at your own personal financial, status, and making the choice that fits you and your family best. All right. So this toolkit makes lots of simplified analysis. This is kind of a fun thing. Remember before when I was showing you the differences between paying more costs or paying less costs? Well, this is another example of that. 4.875, but I'm going to pay through a 0.375 to get it. I am going to pay, I'm going to pay 0.375 to buy down that rate. I could pay 5% and not pay any extra points, or I can get a credit of 0.375, otherwise known as 3/8, and pay a little bit higher rate. These are the advantages to each one. Your situation, you plan on keeping your mortgage for a long time so you can afford to lose a little more at closing. You're satisfied with the market rate without having to pay or get extra points. You don't want to pay a lot of cash up front, and you can't afford a larger payment. So it breaks down what the benefits, what kind of the positives and the negatives are in each category. Learning activity, again. So if that last example, here you will, over the life of the loan, every month pay $14 a month less, okay? Here, it just is what it is. And on this one, you will pay $14 more every month. So do you want to just make your payment? Would you rather make $14 less every month, or pay $14 less every month to have a lower interest rate? Or would you rather keep more of your money now and pay $14 more every month? Everybody's answer is going to be a little bit different. It's knowing, again, the best fit for you. All right, so shop with several lenders. Most mortgage loan officers don't particularly care for that statement. But again, from a consumer standpoint, shop around. Do you go into a store and buy the first thing that you see on the rack, knowing that it could be $3 or $4 or something more cheaper somewhere else? If it's the same exact product, you want to kind of do your research and make sure you're getting the best one for you and working with the best people for you. Again, at the talk, track your loan officer. Who's my lender? What's my loan amount? What's my rate? And here's your loan officer. It's kind of like that shopping cart we showed you on the old good faith estimate. All right, so these ones, again, allow you to compare apples to apples and decide on the one that best fits you. All right, choosing your mortgage. Again, what's your intent to proceed? When should you rate lock? What do those locks mean? Why are they important? And why should I actually make sure I'm tracking my loan along the way to make sure I close on time? All right, again, more about the talk. The talk is rate lock policies vary by lender. That's absolutely true. Checking to lock or float your rate can make an important difference in your monthly payment. To avoid any surprises, what does it mean if I lock my rate today? What rate lock time frame does this estimate provide? These are all the questions you should be asking your loan officer, so that way you know when you should lock and when that's the best decision for you. All right, avoiding any pitfalls, again, isn't that kind of a nice feature? Don't sign any documents where there's any blanks left in because you don't know if somebody's going to fill that in later. Don't assume that you're on your own. HUD has approved housing counselors. Something doesn't make sense and you're not comfortable talking to your mortgage lender or your loan officer, contact HUD. They have housing counselors that can help walk you through this process and help you to understand what you're getting yourself into. All right? Don't take on more mortgage than you can afford. Don't count on refinancing because you have no idea what the market's going to be like when you want to refinance. Don't fudge the numbers on your documents. Number one, that can be considered fraud, and that's never going to be a good thing for you. And don't hide important financial information. It is always discovered. But it's kind of nice that this booklet's together now to advise borrowers in this way, because sometimes they think us loan officers are making it up, and we're not. So we are going to find your hidden financial information, so make sure that you're being on the up and up throughout the entire process. How to handle problems. If you don't like the way something's gone in your transaction, there's a resource for you called, it's on the CFPB's website, it's a consumerfinance.gov/complaint. Doesn't mean that your complaint's automatically going to go against the loan officer, but there will likely be a investigation that will take place to determine if they did anything unethical, uncompliant, or flat out illegal. All right, I think I may have been a victim of predatory lending or loan fraud. So these are the steps that you can take in order to make sure that that situation is handled accordingly. All right, again, you're closing, shopping for the closing services, what's the use or the purpose of the closing agent, title insurance. What is title insurance? How come it's so expensive? What does it do for me? All valuable information. Home inspector and home appraisers. What do they do? What value does it provide me? And how can I make sure I'm using the best one for me? Review your loan estimate. Again, this is really applicable to you and your specifics to your exact loan. Make sure you understand it before you sign anything. Understand and use your closing disclosure. Read those numbers. Are they what you were expecting? Are they what you thought they were going to be? And did something change and you don't understand why? And were you given disclosures and told why there was a change from what you were originally told it was going to be? What is your closing disclosure? It goes through all the things that we just went through. Shows the terms, costs, total loan costs, the prepaid items, escrow information. Is the rate what I expected from my loan estimate? I know whether a prepayment penalty or a balloon payment applies. All of this information is all the stuff that's in your disclosures anyway, but it's a little toolkit to help you through it and see and know all there is to know about what those disclosures mean. Really clear explanations. Calculating cash to close. Closing costs are only a part of the total cash you need to bring to closing. Okay, summaries of transactions. It explains what each section of this disclosure means. So the disclosures are great. They're pretty self-explanatory. It's easy to read, easy to understand. But then you've got this extra toolkit that says you can go back and read about and learn about what goes on in those sections and those categories to make sure no shenanigans are going on and you're getting the deal that you thought you were going to be getting. It gives an explanation of the APR. Thank you, Lord Jesus. That one is one that we have all been looking for years. All right. So many people do not understand the APR. We have no idea how it's calculated, what it means, why is it different from our note rate. Really good explanation of what that is here. Explains your finance charge. Again, breaks it down so that anybody can learn what these things mean. All right. Some afterthoughts. Owning your home. Now that you've closed on your mortgage and the home is yours. Okay, now it's yours, you own it. what do you do now? Okay, well, act fast if you get behind on your mortgage payments. Lenders are now required, or servicers are now required, to consider whether or not your hardship is one that warrants review of your loan, and whether or not you should be given any adjustments in order to make the payments more affordable. All right, keep up with ongoing costs, taxes, insurance. Please make a note. Taxes and insurance will increase, will most likely increase anytime you've got a home loan. Values go up, the taxes go up with it, the insurance goes up with it. So what you want to make sure of is that not only can you afford the loan now, but will you likely be able to afford the loan in the future. All right, other things, note the return on investment calculus mentioned in the last section of the last page. Flood insurance, understanding equity lines, home HELOCs as they're also referred to, and refinancing. What does it mean? How does it work? Why is it valuable? Why is it not a good thing to do? So again, understanding what happens and what can occur after you've closed on your home for the first time. Whole lot of online tools, CFPB website, tools and resources, talking to a housing counselor, general information with the CFPB, how to submit a complaint, and how to share your thoughts, or where you can share your thoughts about what this toolkit did for you. Again, it's a lot of information, but I really think it's valuable. The big question is going to be, is making them easier to understand but longer going to serve the purpose that we're hoping they will? So again, we have had disclosures for decades, then we had revised disclosures, then we had revised disclosures again. Doesn't really matter. Disclosures are always going to be changed and updated. So the question is, are we getting better and making them easier to understand and simplified? Our next major law is the Homeowners Protection Act, abbreviated as HPA. This law is all about private mortgage insurance. Private mortgage insurance is what you will have to pay to a private mortgage insurance company in the event you are putting less than 20% down payment. So again, for easy math, you've got a $100,000 value of a home. You are putting down 20 or less than 20%, which means your loan amount is going to be something more than $80,000. Banks want to make sure that they're going to get some of their investment back in the event you default. So if you're putting less than 20% down, you're going to have mortgage insurance. Having said that, when it comes to PMI and the Homeowners Protection Act, people often say, how does this protect the borrower? It sounds like it protects the lender. Well, here's the thing. PMI does protect the lender. The borrower pays this extra fee for this extra insurance. In case you default, the lender is still going to get some of their money back. However, Homeowners Protection Act says the borrower at some point in time has the right to have it removed or request removal of it. So here are your bases. When the borrower reaches 80% loan to value, so once again, house is worth $100,000. You're putting 10% down. That's $90,000 of a loan you're getting. You put down $10,000. Your balance or your loan is $90,000. That loan's going to have mortgage insurance. So when you've paid down the loan over the years and now the loan reaches $80,000, which is 80%, then you can go back to the lender and say, hey, I'm at the point in my loan where I would not have had mortgage insurance anyway. Can we remove it? Now, what sometimes happens is you get lucky and your value goes up. So now you're like, well, all things being equal, I'm still at 80%, right? My value went up, my loan went a little bit down. All in all, it equals 80% or less in loan to value. Can you remove the mortgage insurance? Well, you can ask to have the mortgage insurance removed, but lenders want what's called skin in the game. If you got lucky, they're probably not going to remove the mortgage insurance. Once you reach 78%, again, of principal reduction, they have to remove it. It's not even something that you need to request. But if you've paid down the principal balance, you've paid down the loan to the point that you would not have had mortgage insurance because you reached 80%, you can submit that and ask for the lender to remove the mortgage insurance. Oftentimes they will say yes. Other times they'll say, well, let us run an appraisal and make sure the value has not come down. Sounds like a little bit of a double standard, right? Well, it kind of is. If values go up and you got lucky in that case, they're not going to let you out of your mortgage insurance. If you've paid the loan down, but your value also dipped a little bit and you're still above the 80% based on the new appraised value, they're going to say, sorry, your appraised value went down. You're not at that 80% mark. So all in all, it means they can say no when it benefits the lender, and they can say no when it benefits the lender. So that's really all it means at the end of the day. So if you get lucky, it doesn't help you, and if you are unlucky, it hurts you. So either way, you have to keep your mortgage insurance in that example. But the Homeowners Protection Act says you have the right to request the removal of your mortgage insurance when your loan to value reaches 80% based on principal reduction, and at 78%, it is required to be removed by the lender. This really applies to fixed and adjustable rate loans on primary residences. If you've got a second home or an investment property, the law doesn't apply to that. Okay, it's only on primary residences. And that's pretty much it on the Homeowners Protection Act. The next major law is ECOA. Now, who remembers what regulation ECOA is? How do you remember this? B. You want all people to be equal. So Regulation B is the same thing as the Equal Credit Opportunity Act, all right? And this law does exactly what it sounds like. It makes sure that people are not being discriminated against. All people should have equal opportunity to obtain credit. And basically that just means that every person, if they qualify for a loan, financially qualify, they should be able to get that loan. Other discriminatory factors should not come into play. So this ensures that all consumers are given equal rights to obtain credit. This was originally addressed because of women. Women were ones that were originally being discriminated against. Now, this law was created in 1974. I thought it was going to show up there somewhere, but it doesn't. It was originally created in 1974. Women were being discriminated against. They were being told, sorry, we don't lend to women, even if you had an income. They were being told, unless you're married and your husband's on the loan, we will not lend to you. So this law was created primarily to help women from being discriminated against when it came to getting a loan for property. So now there's a lot more protected classes other than just sex. So we're going to go over what all of those protected classes are. So like I said, it started off about sex. Age, people are too old or too young, have been discriminated against. Now there's an asterisk next to that because you can discriminate based on age if somebody is too young to enter into a contract, which typically means younger than 18, or if they are older than 62 and they're looking to apply for a reverse mortgage. If you're younger than 62, no reverse mortgage for you. So there are two times that you can actually discriminate based on age. Marital status. Again, you can't be discriminated against because you're divorced or you're widowed or you're single and have never been married. And actually, there are only 3 terms you're legally allowed to use, but we'll share those in just a moment. National origin. Exercising your rights under the Consumer Credit Protection Act. For those of you that don't know what national origin is what nation are you from? All right, so again, if you're from some other nation like it could be a country thing, so it could be like, you're European, that's a nation. So yeah, it could be that you're from some other national origin. Exercising your rights under the Consumer Credit Protection Act. That's kind of long and wordy. What it basically means is you have rights as a consumer to not disclose certain information. Like, I don't need to tell you about a second job I have if I don't want you to use the income to qualify. So back in the day, I was actually working in the mortgage industry. I was a processor, and I was saving up to buy a condo. I went out and got a second job for a couple of years so that I could save up the money for the down payment. I was working at Denny's, graveyard shift, Friday, Saturday, and Sunday. Not a glamorous time in my life, believe me. But I didn't want the income from my second job to be considered. To be honest, I was a little embarrassed about working at Denny's graveyard shift as a waitress. So I didn't tell my lender. Fully my right to not tell my lender, don't calculate the income, act as if it doesn't exist. I'm not going to go to the people at Denny's and get all this documentation. So no, I don't want to tell you about it. And by law, they can't make me. Act like I don't receive the income. I don't care. It's fine. Don't put it into the factor of the equation, and it's fine. Well, they cannot make you disclose income if you don't want them to consider it. Okay, same thing with like alimony or child support. If you're receiving alimony or child support, but you don't want it as a factor in the equation, you don't have to mention it. Oftentimes, underwriters will come back and say, oh, you're receiving alimony income, I need documentation. No, you don't. Take it out. Act like I don't receive it. I want to qualify without it. They cannot require any documentation on it because it's not being used to consider. So that's what we mean by exercising your rights under the CCPA, the Consumer Credit Protection Act. If I don't want you to consider that income, I don't have to tell you about it. All right, color, that one's pretty simple. Receipt of public assistance. Most people don't realize that Social Security income is public assistance income. All right, it's a social program. Well, if you are receiving Social Security income, we cannot discriminate against you. We cannot say, sorry, we don't use Social Security income to qualify. If you are on permanent disability, permanent means permanent. There's no variations of that term. Permanent is permanent. So that means you're going to receive it forever, right? Well, if you are receiving Social Security and it is permanent, we have to use it to consider, or we have to consider it in your debt ratios and your monthly income as to qualifying for the loan. We can't say, oh, well, you're receiving a government assistance program, you don't qualify. They won't, that's discriminating against the borrower, and it's violating the Equal Credit Opportunity Act. All right, and then of course, race and religion. Again, it doesn't matter what religion somebody practices. It has no bearing whatsoever on whether or not they can afford their mortgage payment. Same thing with race. Doesn't matter if you are white or black or Asian Pacific Islander or whatever, or I think those are two different ones actually. So it doesn't matter what your race is. It does not have a bearing on whether or not you can financially afford this loan. So cannot be considered into the loan equation. All right, income. We actually just talked about this. Cannot discount or refuse to consider public assistance income. Income based on sex or marital status. I know that there's a whole lot of programs available today, but there used to be something called affirmative action, and people were able to receive certain amounts of income from either cities, states, or from a federal level based on sex or marital status. I know there's other programs like WIC, which is Women, Infant, and Children. If you're receiving income on that or some type of benefit, we cannot discriminate against you because you receive those benefits. Income from part-time employment. I gave you my Denny's example. Right? Regular alimony, child support, or separate maintenance. I have the right to not disclose it if I don't want you to use it. Cannot discriminate against an applicant who chooses the rights to non-disclosure. Don't use it. I don't tell you about it. We're even. All right, disclosures. Under the Equal Credit Opportunity Act, or under ECOA, you have the right to receive a copy of your appraisal, which makes sense. You pay for it. So you need to know what is in this appraisal that could affect your ability to keep this house. If there's a boundary issue, you want to know about that. If there's a problem with the foundation, you want to know about that. So part of the reason that you are entitled to a copy of the appraisal report is because you have the right to know any details and all details about the home that you are buying to make sure it's, again, the type of property you want to get yourself into. Now, you have 30 days to notify the borrower of their credit decision. Which is your loan's approved, okay? Your loan is denied, which is the bottom one, or you have a notice of incomplete application. Something's missing on the loan application. I don't have your W-2s, I don't have your pay stubs, I don't have your tax returns, I don't have your divorce decree, whatever it is, that would be a notice of incomplete application. So within 30 days of you submitting your loan package to the lender, and by loan package I really mean the loan application, you have to get a letter, or you're entitled to know what the heck is the status of my loan within 30 days, which means you're getting a letter that's saying you're approved, your application was incomplete, we cannot determine if you qualify, or your loan is denied. And the denial is generally called statement of adverse action. All right, that's pretty much it, the highlights on ECOA. once again, remember, this test prep video is not meant to be a standalone independent course. You want to make sure you're going back to your 20-hour materials. If you have not taken a 20-hour class yet, contact Loan Officer School right now to make sure that you get enrolled in a 20-hour program. That's going to have all the nuts and bolts of each of these details all the way down to the fine details. I could do this course over 40 hours and I still wouldn't have covered everything. So that's why we're just covering the highlights here. All right, Fair Housing Act. The way I remember that the Fair Housing Act is the one law that reports to HUD and not CFPB is because of housing being in the term, okay? Housing. So the Fair Housing Act reports to the Department of Housing and Urban Development. So just another way to help keep this information straight. Now, Fair Housing Act is a part of the Civil Rights Act that was actually created in 1866. Now, Civil Rights Act was created in 1866. Fair Housing Act became a part of it in 1968. So again, it's no matter how you slice it, it's still been around for a long time. This law prohibits the discrimination in pretty much any housing transaction. That would be renting, leasing, buying, selling, living space, or housing space. There are certain exemptions when you do not have to adhere to the Fair Housing Act rules of discrimination. If I own a home and I'm renting out a room in my home, I have the right to discriminate against anybody I want. I'm not putting anybody that I'm not comfortable with in my home with my family. So that gives me the right to discriminate for any reason I choose. A single family house sold or rented by a private owner. So let's say I own my house I live in, but I also own another home that I rent out. Those are the only two homes I own. I believe the law is 5 properties or less. You do not have to adhere to the Fair Housing Act. If I own more than 5 houses or 5 properties, I have to adhere to the Fair Housing Act. So if I said here on the single family owned by me, that's my house. I property manage it. I do all the details and all the fixing up. I have the right, as that is my home. I'm not doing this as a big business or anything. I am the owner of that property. I get to decide who's going to live in it. I don't want somebody trashing my house. If I have a problem with whoever is, looking to rent it, I have the right to discriminate based on anything that I choose. As long as I'm not using a real estate agent or a property manager to manage that property. If I am, then I have to follow fair housing. If I'm not, and I'm managing it myself, then I get to discriminate as I choose. And other things like housing for organizations or private clubs. A lot of times, I know it's very common in like the Berkeley area and pretty much any big college town. A lot of times houses have been converted to sororities or fraternity houses. So when they are used for a private organization or a club, even religious groups have, homes that they, rent out to people, or they allow folks to live there because they're going through a hardship. Those are allowed to discriminate. All right. When it comes to the Fair Housing Act, there are 7 protected classes. Oops, sorry, rewind. All right. I remember it this way. When you have Fair Housing Act, wouldn't you be more fair to your friends? See what I mean? So it kind of spells friends like the text version of friends because you leave out all the vowels. So you'd be more fair to your friends. See what I mean? So F is family status, R is race, R is religion, N is national origin, D is disability, S is sex, and C is color. Okay, so those are the 7 protected classes under fair housing. Family status, how does that vary from marital status? Family status means you cannot discriminate based on children, anybody under the age of 18. So if you've got a 1-bedroom house and you have 5 kids and yourself, or you and your spouse, that's 7 people living under one roof. But it's the children is the outnumbering factor. A landlord that does not fall under fair housing cannot tell you, sorry, you can't rent a 1-bedroom apartment when you have 5 kids. That would be a violation of the Fair Housing Act. Why? Because it's discrimination based on the size of their family or their family status. And that again is a really big deal. A lot of companies don't even realize that you cannot discriminate based on that. But here's the thing. If I and my income only allow me to afford a one-bedroom apartment and the landlord won't let me live there because I have 5 kids, the only other choice is to go get a 2-bedroom or something bigger that's going to cost more. But my income won't allow me to get into something bigger. So what are your options? Be homeless? Live in a cardboard box underneath the freeway? Not exactly, what the government wants, our families to be subjected to. So that's why it's a protected class, because you can't tell someone, I know you can't afford a bigger place, you can afford the 1-bedroom, but you have too many kids for it. So again, family status is protected under the Fair Housing Act. Similar to what the others were: race, religion, national origin, disability, sex, and color. And actually, while I was saying this, I realized I forgot to tell you my funny little acronym for the Equal Credit Opportunity Act. ECOA, stepping back a few laws, they had 9 protected classes. We talked about them, but I didn't give you my acronym. It's sex, age, marital status, all those good things. Well, let me show you over here how I remember that. It's kind of a funny little goofy way. I always get comments and emails and phone calls later on about how goofy this example is, but it's funny, so I'm going to share it with you anyway. All right, so ECOA, Equal Credit Opportunity Act, was created about sex, right? The discrimination of women, remember? It was created in 1974 and to protect women against being discriminated against. So if I can remember, ECOA was started about sex. I think of this funny word called Sam Necker. Just yesterday, I was doing a class for continued education, and somebody who attended my class years ago says, all I remember about the 20 hours of education is that ECOA has 9 protected classes and it spells Sam Necker. What the heck is this? Well, I think about this guy named Sam, and he was necking, and it made him go, and that's your rolled R's, okay? So sex, age, marital status, again, terrible penmanship, especially when I'm in a hurry, national origin, exercising rights to CCPA, color, race, religion, and rights to receive public assistance. Okay, so that's a fun little trick and probably something you'll never forget because it's so absolutely off the wall and goofy to remember what the 9 protected classes of ECOA are. Okay, so continuing on with the rest of our laws, 7 protected classes under fair housing, 9 protected classes under ECOA. Here's another little trick. ECOA is the Equal Credit Opportunity Act. It is a longer word or longer title than Fair Housing Act. Fair Housing Act's short, Equal Credit Opportunity Act is long. The longer one has more classes, the protected classes, the shorter one has fewer classes. And housing has 7 letters in it. 7 letters, 7 protected classes. So again, just some tips and tricks on how to remember some of these laws and what they do.